The ultimate moat, Ferrari. That is my opinion. To me, I believe that the ultimate moat company is Ferrari. Limited supply, amazing demand. The world's getting richer, expanding its market of who wants to buy this car. Africa is their fastest growing market. It is an incredible company. In this video, we're going to look at the high level metrics. We're going to look at analyst estimates. We're going to look at our 8-pillar process. We're going to look at bull and bear cases, and we're going to finish it up with the most important question, but the hardest question. What's the right price to pay for Ferrari? Now, in this video, we're going to have things for beginners and things for more advanced investors and everything in between. So watch the entire video. You will learn something no matter what level you're at. I still learn things from the very basic information. And I actually try to avoid the more technical information. What I'm focused on is buying good companies at good prices. That's really what I'm focused on, buying great companies at good prices. Ferrari to me is a great company, and here is why. Ferrari can raise its prices. Ferrari can do all these things. And guess what's going to happen? They're still going to sell a crap ton of cars. In Florida, there's a Ferrari dealership. I went in there one day just to see some cars, and the salesman there was very nice. And he said to me, you know what a lot of our customers do? They order a new Ferrari. They get it delivered. They pay X amount of dollars, call it $500,000 for it. They drive it around for 2 years. But they also, upon picking up their new car, put an order for a new one in. When the second one comes in, they trade the $500,000 one in. Maybe they get $700,000 for it because the car goes up in value, and buy the second one and keep rinse and repeat. Ferrari has done a great job of making this car company the elite of car companies and making it a high demand item. Now, they're also selling more cars. 5-6 years ago, they were selling about 7,000 or 8,000 cars a year. It's now up to 13,000. The question is, how much more can it go up? So to me, this is a company where you can pay a premium for the company. Let's pull it up in our software because I want to show you some of the things I love about Ferrari. First things first. It's a $56.5 billion company. That means that's the market cap. If you bought all of their shares outstanding, you have to pay $56.5 billion to own every single share. Its enterprise value is $61 billion. So this $5 billion difference is their debt, essentially. Okay? Now, doesn't sound like a lot, but their 5-year average free cash flow is about $500 million. So it would take about 10 years of that free cash flow to pay the difference there. But again, very large moat. I think these guys can support more debt levels. All right. Now, one thing I don't like about Ferrari, their 1-year net income is $1.1 billion, but their 1-year free cash flow is $700 million. Their 5-year net income is $900 million, and their 5-year free cash flow is $500 million. So their free cash flow is always significantly lower than their net income. I don't like that. I don't like that in any company. I want it the other way around, or those numbers to be very similar. But it's been a very consistent thing for Ferrari, and it makes me wonder why that is. I don't know why that is, but it really concerns me. Net income is a number that can be adjusted for based on SEC rules, GAAP rules, all these different accounting rules. Cash flow is a lot harder to manipulate. So to me, I always look at the cash flow as what is the real lifeblood of the business, and it's the cash flow. You know, you have a company like American Express where their cash flow is much greater than their net income. There are a few companies like that. But a company like Netflix, it's always concerned me because their net income is always higher than their cash flow. I always get concerned when I see that. There's a lot of investors out there who won't even buy a company unless the free cash flow is 80% at least of the net income. In this situation, we have free cash flow that's 50%, now maybe 60% of their net income. So the 5-year average free cash flow of $500 million, $900 million for the net income, that's 45%. Nope, sorry, 55%. That's a little concerning. All right, so let's go on. 5-year return on invested capital, 16%. By the way, this is very large for a car company. And that's the thing. The one thing I think Ferrari is like a branding company. They're not a car company. And a lot of people will make fun of me for that because everybody talks about how Tesla is not a car company, they're a tech company. But look at the margins on Ferrari. The average car company has 15 to 20% gross margin. That means for every car they sell, they make about 15 or 20% on it. Ferrari is 49%. And their bottom line is about 20%. So they have a bottom line profit higher, that's after taxes, higher than most other car companies have a gross margin. They make more to the bottom line after all expenses and taxes than most car companies make on every additional unit they sell. Think about that, guys. That's Ferrari for you. They're barely paying a dividend, but it's there. All right, let's go check out the 8 pillars on Ferrari. All right, a few X's here. Obviously, the valuation metrics. It's selling for 62 times 5-year earnings and 110 times 5-year free cash flow. Do I think Ferrari should go for a premium? Absolutely. But how much of a premium? That's the question. You know, when Warren Buffett started buying Coke back in 1987, he paid 30 times Coke's value in his first purchase. And he still made 11.5% since then with dividends and capital growth. The question is, how much should you pay as a premium for Ferrari? Now, the debt level, that's the other thing here. Remember I mentioned the debt level before? All right, it's there. It's an X. I'm fine with, I'm okay with that one. But this high return on invested capital, don't like they're buying back shares on such an expensive company. But everything else is a check. And I think that Ferrari, if they raise their prices 10% tomorrow, would be fine raising their prices 10% tomorrow. Because when I was at the dealership in Florida, I said to them, let's say I put a new order in today. And first off, I have to be in their system. I don't own a Ferrari. So they want you to be in their system. Go buy a used Ferrari first, get in their system, then you place an order. He said it's 18 months to 24 months to get a car. Pretty impressive. Pretty impressive. And I'm quite sure that Ferrari as a brand will want to keep that continuing on. More demand and limited supply. That's what they want. That's how you keep prices high. All right. So let's go see what analysts are saying about Ferrari. Earnings per share, growth. $7.12 expected this year per share, $9.60 in 4 years. So decent growth, nothing huge, but decent. And revenue growth, $6.44 billion this year, going to $8.18. Again, slow and steady growth. The best brands in the world, the Louis Vuittons, the Hermes, all these ones, the Ferrari, Rolex, they want to keep supply limited now. They saw what happened after COVID, and I think they like that. And frankly, I like that. You know, I'm a watch collector. I've got a lot of watches. I like the fact that now it's harder to get watches because it allows me to sit there and establish my relationship with my watch vendor and say, hey, I want this watch and I'm probably going to get it because I've already bought watches. I don't want some random person coming off the street and saying, hey, I want that watch, and they give it to them. Same with Ferrari. They're trying to make it more exclusive of a brand. They actually told me, if you ever want a new Ferrari, you got to go buy a used Ferrari first. Get into our system. That's incredible. That is really, really incredible. And I love that. I think it's a great thing for Ferrari. All right, let's check out some news on Ferrari. So first off, Ferrari CEO says nearly 1/3 of new buyers are under the age of 40. That's awesome. That means they're building the brand with the younger crowd. Because those people under 40 have 50 or 60 years left to live. And for hard car people with money, that's a good thing. In fact, it's funny, I did see this. Someone just paid almost $2 million for a rusted out shell of a 1954 Ferrari. Let me show you guys a picture. Burnt out shell of 1954 Ferrari fetches $2 million at auction. Look at this. That's incredible. That's how valuable that is. Years and years ago, I went to somebody's house in Northeast Ohio. Has a lot of Ferraris, and he just spent like $7 million buying a vintage Ferrari. And he asked me to hold the hood with them. He's like, "Hey, lift the hood for me." I literally went to something. I'm not touching that thing because he just explained to me how even a minor crack in the paint can change the value by millions of dollars. And I was like, "I ain't touching that thing." That's how incredible. Okay, a couple bull cases. U.S. and China are seeing growth in luxury car demand, while South Korea is also becoming a target. They came out with two new limited models, and the entire production is already sold out, and expecting 15 new car launches up till 2026. That is incredible. Wow. Okay, two bear cases. Oh yeah, the company's actively repurchasing stock. I hate that. They just announced a $200 million share buyback program in June. Why do people overpay for their own stock? You know why they do that? Because people love hearing share buybacks, but they don't realize it's only good to buy back shares if your company prices are cheap. And I have a hard time believing that 60 and 100 times earnings and free cash flow over the last 5 years is cheap. I could be wrong, though. Let's see what else we got here. Here's something, a comment from somebody. The Black Mage 3 disagrees with me. He says, I disagree that it's the ultimate moat. Exclusivity prevents scalability. Also, I don't think it's essential to the consumer as something like the iPhone. Okay, I believe that. But then he says, in the terms of luxury brands, I think something like Louis Vuitton is a better brand. Well, it's just Louis Vuitton at a different scale. I get what he's saying. He thinks moat in the sense of it's hard, it's less people are gonna, but you can have a moat on a very finite market. And I think that's what I have with Ferrari. So this is a YouTube comment back from the Black Mage, and I really appreciate it for your comment. And I see your point. That is a valid point to say, hey, listen, it's a small brand, but Louis Vuitton purses they're still exclusive. Now, a lot more people have them than Ferrari, but it's also 3,000 or 4,000 versus 300,000 or 400,000. So I still believe that Ferrari is the ultimate moat because I do believe that they have, within an industry, a very tough industry, they kick butt. They have high gross margins, high profit margins, high return on invested capital. And people, literally, if a dealership gets a Ferrari in tomorrow, they would have it sold like that. And that's the way it's been going for a while. All right, so ultimate question. What's the right price to pay for Ferrari? Now, this is our stock analyzer tool. So guys, all of this software is available for you at everythingmoney.com. Everything you've seen us do so far, the stock analyzer tool, which has been used millions of times since we founded it, and then also all these tools. And the best part is, guys, everything I've shown you and everything up there is available on your mobile phone in our fully functional app. But most importantly, the community. Thousands of like-minded investors like you in there talking every single day because investing can be a lonely road. And this is a community of thousands of people to share your ideas with and help you through the tough times. So go to everythingmoney.com. We are running a special, $10 off per month. Get there now because with that $10 off, you're about $1 a day for the cost of the software. It's $1 a day to get complete peace of mind and tools to help you make you a better investor. Everythingmoney.com. Go check it out right now. Now, when was the last time I did Ferrari? So I'm going to go to my history of our stock analyzer tool. May 15th of 2023, I did a 20-year analysis. Now, let me go see if I still agree with these assumptions. So back then, for revenue growth, I did 5, 9, and 13%. I still like that. And I look at this going, I think that their tailwinds on revenue growth are much bigger now than they were 10 years ago. Profit margin, yeah, I actually went lower than I expected, 17, 18 and a half, and 20. I think I'm going to alter this right now. I'm going to do 18, 19 and a half, and 21. Now, free cash flow. I still like this. I did 10 and a half, 11 and a half, and 12 and a half. And guys, I will repeat till I'm blue in the face. I hate the fact that these differ so much. I need to understand that. So if we hit the stock analyzer tool and the price is close to where we want it to be, I will do more research on why this difference exists. But if it's not, I'm not going to worry about that yet. I'm going to add it to my watch list at whatever price makes sense, and then I'll do more research. This is about screening out companies. It's not about making a buy decision just because it's here. It's about saying, okay, we're either at the price I want or close to it. Let me go do more research. The stock is currently at $313 a share. All right, now for PE, I'm going to change the PE here. I put low 18, middle 23, a high 28. I lied. I'm keeping the PE here because I think to myself, 18, 23, and 28, I'm willing to pay a premium for Ferrari. Could I see you justifying 25 or 30? Sure. That's the hard part about investing. We don't know the right multiple to give at the end of these 10 years. We don't know because right now it's at 49 and 79. Is that right or wrong? I don't know. That's the hard part. But it's all about determining what you want to make on this company. So then we go to our desired return. 10, 12, 14. I'm actually going to change this one a little bit. I'm actually going to go 9, 11.5, and 14. Because I'm okay making 9% owning Ferrari if they do a terrible job and do these low margins here. And I'm okay making 11.5% if they do about what I expect them. In fact, I can make the argument of going lower on this middle range. But the high range, I like this 14% because these will all be very, very difficult to hit. So I want to make that return if I do that. So guys, I'm going to hit the analyze button again. Please go to everythingmoney.com. It'll really change the way in which you invest. It's only $1 a day and you get that community here because I assure you there are people in there talking about our company. So about this company, hit the analyze button. Okay, we have a low price of 75 to 130. a high price of 167 to 280, and a middle price of 112 to 190. I have it on my watch list at 150. I'm actually going to change that. I'm going to add it to my watch list at 175. And guys, if you look back at our past videos, this keeps going up. Now, if you pay today's price for the company and the low assumptions occur, you're going to lose money over the next 10 years. If the middle assumptions occur, you're going to make about 4.5%. If the high assumptions occur, 9.7. So for me, I just need to be more patient, and I'm okay with that. I add it to my watch list at 175. If and when it gets there, I'll take a look. If it doesn't, I'm cool with that. Guys, thank you very much for your time. I appreciate it.